All right, here we go. Three, two, one. And we're live. We are so live that we're live. How about that? Hey, thanks for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's a show about personal finance, investing, money, interest rates, inflation. We talk about it all. I try to help you make heads and tails of the news of what's going on in the economy. Um, we hear a lot of initials around like FOMC and you know inside baseball words and language, and I want to make sure you have a firm grasp of this because you have to make really big investment decisions and other personal finance decisions, and I want to make sure that you are equipped to make the best possible decision for your situation. And that's what this is about. We put the personal into personal finance. You could ask 10 people the same money related question and often get 10 different answers because it's personal. We have our own idea of what is best for us. We have our own um, idea of not only what's best for us, but how best to go about something. We have biases. We've sometimes someone is successful doing something and another person is not successful doing the same thing. These things shape us. Anyway, let's talk about the market. Let's talk about the economy, inflation, and interest rates. These are important. You see what inflation does to your purchasing power. So, your purchasing power simply means how much you get for your money. And so, think of it this way: you go to the supermarket, you fill up the basket, it costs you a certain amount of money when you uh, check out. You know, when you check out of the supermarket, it costs you a certain amount of money. And then a month later, it costs you even more to check out for the same stuff and the same goods in the basket. And then a month later, it costs you even more and you pay more. You pay for it. Or you put a few things back and you decide, well, I don't need this, and that. And you start to think, what could I cut back on? And once you start to cut back on things, you realize that you could live without them. It could even make you go into um, a permanent thing in terms of not buying those items that you no longer need. It's amazing how we spend money on things that we think we need, and then we get used to spending money on those things, and then we just keep it going. It's kind of like a gym membership that you don't use. How many people are paying for a gym membership for a gym they never go to or they hardly ever go to? And once you get rid of that expense, you realize I should have gotten rid of this sooner. And by the way, when you get rid of a subscription or a monthly bill, just so you know, if you want to know what makes it really easy to get rid of a monthly bill, realize that they'll be happy to take you back. If you cut Netflix, you cut the Disney Channel, you cut Paramount, you cut some service you're using for your business every month that you don't really utilize, but you thought it was a great idea at the time. And you think, but one day I will use it because I know it'll come in handy. So I'm just going to keep it for now. Once you get rid of those, you realize that they'll take you back. Believe me, that subscription you had, they will always take you back. So get rid of it and see if you can live without it. Don't get rid of something that you use, though. I mean, people think budgeting is about spending less money. Now, budgeting helps you spend less money, but what it's really about is prioritizing what you spend your money on. Spend on your priorities, cut the rest. And you'd be amazed, what's not a priority. That's how I think of budgeting. That's how I keep it going. Anyway, we're going to talk about the market. We're going to talk about inflation. We're going to talk about interest rates. So inflation is purchasing power. It's the opposite of purchasing power, right? Inflation goes up, purchasing power goes down. That's why I gave you the example of filling up your basket at your shopping cart at the supermarket, because you buy less, or you put things back, or you just pay up. You don't really have a choice. You've got to do one of those things. It tells you a lot about people who are willing to cut back, and it tells you a lot about people who are not willing to cut back. And it tells you how stubborn someone is. I could tell a lot about a person by looking at them financially. When I look at someone's spending patterns and finances and assets and liabilities, the car they drive, it tells me a lot. And by the way, I don't want you to think if somebody drives an expensive car that they're a spendthrift, that I judge them. No, I don't. I have plenty of clients who drive very fancy, beautiful cars, and they can easily afford those cars. But it's when I see somebody who really can't afford the car, they don't save a penny at the end of the month. They don't contribute to any kind of retirement plan. They don't own any real estate. They don't own any assets. Maybe they have their family home, but they don't own any other pieces of real estate. I could tell what I could tell. I mean that's who maybe I'll judge a little bit, right? So these are the things that we do. Okay, so I digress. While you're watching this, hey, if you don't mind, give us a thumbs up, a heart, an applause, a wow, whatever reaction is available to you, depending on which social media platform you're watching from. Your comments, I should say your questions in the comments are always welcome. I love hearing from you. It's the best part about doing this. Words of encouragement are always appreciated, or just jump into the comments and say hi, or hit me with your favorite emoji. That's always fun too. And when you do that, and when you give us a thumbs up, it spreads the word to the rest of your contacts in LinkedIn, your friends on Facebook, your connections on Twitter, YouTube, etc., that they see it. They will see the good work that we're doing. It's all educational. Okay. And if you can spread the joy a little bit, that's always a nice thing as well. So today we want to talk about a couple of things, in particular stock market. By the time we come back tomorrow, we will be past the Fed's rate hike, which is expected tomorrow on Wednesday. The Fed has a 2-day meeting today and tomorrow. Why they have to meet at all when we all expect the Fed to just raise interest rates by 75 basis points? The meeting, it just becomes pointless, right? They're going to just have a lot of deliberation to get to the same conclusion, I guess. But that's what we're betting on, is 0.75%. Okay. And that's not all interest rates. The Fed controls, there's two interest rates that the Fed controls. There's the discount rate. That's what banks get charged when they borrow directly from the Federal Reserve. And there's the federal funds rate, which is what banks pay when they borrow from other banks. Just so you know, banks are borrowing and lending to each other all the time. All banks have to have certain capital requirements settled by the end of the day, and they just go back and forth with lending each other excess capital or borrowing capital if they need a little extra capital. And that's what the banks, that's what they do. That's what the federal funds rate is. And the higher the Fed funds rate is, it makes other interest rates go up, where it has a tendency to push other rates up. Okay. So that's why when the Fed raises rates, it slows the economy down, because if you're going to borrow money and pay X amount of dollars every month, like a mortgage, for example, and then a year later, mortgage rates are a lot higher and people have to pay 30 or 40% more every month for the same dollar amount that they borrowed on a mortgage, they might say, I can't afford that. I'm not going to buy a house. By the way, when people don't buy houses, they don't buy new carpet. They don't buy new appliances, new shingles, new windows, and all of the other wonderful, glorious things that you get to spend all your money on that hole in the ground called a house. And there are some time periods when houses go up appreciably, like the one we've been in for the last 2 years. And there are times when houses stay flat in price for a very, very long time. And there are times when they go down. There's no one silver bullet type of investment. So anyway, let's roll the introduction. I've got a couple of things to show you. We've got the stock of the day. I've got the weird thing of the day. I should do that like every day, the weird thing of the day. So let's get to the intro. And then I've got a good show. I've got like 7 points to go through with you, and they're going to be really good. So stick with me. Stay till the end. Here we go. All right. Hopefully the full intro went through. Sometimes it gets a little jammed up on my end, and you see me just staring into the camera like this, waiting for the intro to end. So I'll just throw in a quick disclaimer here. You cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. Okay. Also, want to get this disclaimer in here. Don't bet on slow horses. Yep. I don't know if that's really a disclaimer or just a silly tip, but I figured I better squeeze everything in here while I can. So let's take a look at how the major averages did. All right. Prop myself up here. So the Dow continues to trade lower, down over 1%, down 300 points. NASDAQ down 109 points. S&P down quite a bit, down over 1%, down 43 points, or just about 44, down 1.13%. So here's the thing. We all follow the Dow Jones, okay? We follow the Dow. It's easy to see. You're up 100, up 500, down 200, down 800. We follow the Dow, and when the Dow has a big move, you hear about it. The Dow was down last week, for example. The Dow was down almost 1,300 points in one day after last week's hotter than expected consumer price index numbers. The inflation numbers came out a little bit hotter, a little higher than expected. So you hear about the Dow being down over 1,000 points. And then you hear, oh, by the way, the S&P was down 3%. So even though we know the S&P is a much bigger, broader based index to track, which gives you a much better sense of what the overall stock market is doing, we follow the Dow. But just so you know, when you look at the S&P, in my opinion, I look at a percentage point, S&P up or down 1% as a move that gets my attention. Okay. So if you want to put things in perspective, the S&P, let's look at where it closed today. It closed at 3,855. Okay. So let's just look at the first two numbers and say 38. That's 1%. 1% of 3,855 is 38.55. We'll just go by the first two numbers, 38. If the S&P is up more or less than 38 points tomorrow, we'll know that it's a pretty good move and something we want to at least pay attention to and see what was behind it. I'm not saying you should make an investment decision on that, but I am saying that you should look at it though, and at least if you follow the markets, look at the 1% plus moves. Okay, so 38 points is a 1% move. This helps put in perspective because you never really hear people say, "Oh, the S&P was down 44 points today." If I tell you the S&P was down 44 points, you'll be like, "I don't know, is that a lot? 44 points doesn't sound like a lot because you're used to bigger moves from the Dow Jones Industrial Average, but the Dow Jones is at 30,000 plus, where the S&P is only 3,800. So 43 points might not sound like a big move to some people. Some people might sound like a big move. But to put it in perspective, just take a look at 38, the first two digits of the S&P 500, where it closed 38. And the next day, if it's up or down more than 38 points, you'll know it was a pretty nice move. Same with the NASDAQ, 11,400. It used to be if the NASDAQ was down 109 points or about 110 points like it is today, that was a pretty significant day. That was crazy to see move that big. Now, not so much. So NASDAQ closed today at 11,425. So if the NASDAQ has 114 points, look at the first three digits, 1% move, 114 points up or down tomorrow. That's a move that I'll take a look at. It gets my attention. And that's how I more or less can tell if a index is moving quickly in one way or another. Just a little something I do, a little tip for you to help you get used to following the S&P 500 and the NASDAQ in terms of points and percentages, not just the Dow Jones Industrial Average, which is something that we hear a lot about because it's just so prominent in the media. Okay. In the meantime, gold continues its descent. Oil is hanging in there between 80 and 90 in the consistent range. The 10-year yield at 3.55%. Okay. It did hit 3.6%. So the 10-year yield hit its highest level since 2011. All right. The VIX was up modestly, up 5%. For an index, that's a lot, 5%. Okay. But for the VIX, 5% up or down is kind of normal for the VIX. Okay. The volatility index itself is pretty volatile. All right. But at 27. And let's go on and take a look at the bond market. This is significant. The 1 year is 4.03%. Now, here's something I can tell you. The 1 year treasury, it's about it's treasuries are considered safe. Short-term treasuries are considered safe and stable. And I can say that. They're safe. They're backed. They're guaranteed for payment for principal and interest by the US government. Okay? And it's the only investment that truly comes with a guarantee that we could put our money into. Unlike other products like an annuity or something, they're guaranteed. Yeah, they're guaranteed by an insurance company, but there's no better guarantee for money than the U.S. government for Treasury securities. Okay, you could buy a 1 year CD for maybe 2.5%, but you could buy a 1 year Treasury for 4%, and with a Treasury, you don't have to pay state and local taxes. A CD, you do. So I don't know why people are buying CDs, but I would much rather take a look right now at the Treasury, the 1 year T-bill. But from 6 months to 18 months to 1 year to 2 years, 3.97. This is the highest it's been since 2007. I mean, there are many people in my industry who were not even in the business in 2007. But these are pretty attractive short-term yields compared to where they've been for such a long time. And for someone who says, I'm going to hold on to this cash for the next year, 2, 3 years, I'm not going to do anything with it, that would be a good place for a short-term treasury security. That's a scenario where a T-bill could make sense. Now, if you said, I'm going to need that money in 6 months, I wouldn't recommend you buy a 1 year T-bill, because if interest rates do continue to go up, the value of the T-bill presumably will go down, and you don't want to be stuck in the position of selling it for a loss and having even less money for a financial obligation that you have in 6 months. In that case, you go with a 6-month T-bill or 90-day T-bill, or just leave it in the money market. Okay, but there are pretty good choices now for interest rates, and these choices for higher rates, especially the 6-month, 18-month, 1 year, and 2 year T-bills, they're actually starting to give the stock market a little competition. And from what I'm hearing, this definitely goes for my world, for my clientele, but investors who have money in the sideline are not buying up stocks, they're buying up short-term treasuries. Okay, it's a very popular trade. We talked about this like 2 weeks ago. We talked about it last week, and we're still talking about it. But there was a big article in CNBC this past Friday. Jeff Gundlach of Double Line Capital Management, he's considered the bond king. He said on CNBC, well, you get the 2 year yield guarantee for almost 4% on the 2 year Treasury. I said that days before him. I just want to throw that out there that, I don't just parrot what I see in major media. I have an opinion. I have insights. I've been doing this for a long time, and it's nice to be ahead of the curve. Okay, so we've got somebody out there. We got Slayer with 2 thumbs up. Thank you very much. Thank you for hitting me with the emojis. Thank you for listening. You follow directions. Thank you. You honored my request, and I appreciate that. It means a lot to me. And folks, while you're out there, don't forget, give us a thumbs up. Come on, spreads the word. Your contacts will see the good work we're doing here. Makes me feel good. It'll make you feel good too. There's nothing that could make you feel better than hitting the like button. Try it. You'll see. Go ahead. Do it. Go ahead. Okay. Comments. Sir, if you have questions, hit me up in the comments. Words of wisdom, words of encouragement are always appreciated in the comments. Thank you. So let's go on. The 10-year yield, 3.569. So with the 1 year at 4% and the 10-year Let me show you this. With the 1 year at 4.04% and the 10 year at just about 3.6%, it's pretty steeply inverted yield curve. And again, that's a harbinger of recession, slower economic times. And I want to talk to you about something from my live stream yesterday. Yesterday, I had a really good guest on, Joe Bonacci. He's a CFA, very smart guy and a friend of mine. And he's just great to talk to because he'll tell you, even though he's an analyst and strategist, he talks in ways that we like to talk, in ways like person to person we understand. He said he feels we're not in a recession. There's no way, with unemployment this low, the labor market this strong, wages going up. There's no way we're in a recession. Now that goes counter to what I've been saying, which is we're in a recession. We had 2 negative quarters of GDP. By the way, the definition of a recession being 2 quarters of negative GDP or negative GDP in the first quarter and then the second quarter. I don't know where that rule comes from, that automatically 2 quarters of negative GDP means we're in a recession. We had a recession in 2020 when the pandemic hit, and we did not get 2 quarters in a row at that point when we were in a recession. It was like one of the fastest recessions ever, and government dollars got us out. Okay. I see Rita out there with the wave. Hi, Rita. Thank you very much. Hey. Hey, girl. Hey. Thank you. But the National Association of Economists, the NABE, okay, that is who decides if we're in a recession or not. And nowhere on their website will you find that 2 quarters in a row of negative GDP equals a recession. But I do think we're in a recession. It's a weird recession because we're not getting recession-like statistics. But I don't think they tell the full story. And I think as people finally get their fill of travel and leisure after being shut in from the pandemic, once that starts to wane, we'll probably see a slowdown, more of a slowdown in the economy. We'll probably see unemployment rise. And now with inflation, it's getting very expensive to travel and to go out to dinner. So these are the things that I look at. Now let's look at the weirdest thing of the day. Okay, did you guys see this? You have to check this out. The Beyond Meat chief, I guess the chief operating officer, I don't know if he's the CFO or the COO, but one of the top people, Beyond Meat, suspended after arrest for allegedly biting a man's nose. Here he is. If you see this guy and you get into a little tussle with him, he will bite. He bites. Okay. Careful. It bites. Back up. And he basically, I guess he bit the tip of somebody's nose off. But anyway, he was arrested, then released, had a really good job at Beyond Meat, whose stock, by the way, has plunged from a $13 billion market cap to about $1 billion market cap. And I don't even know if it's worth that much, but stock plunge. But this guy bit somebody's nose. Don't bite your nose, just bite your face. I'm thinking, I don't know, but look at that guy. It's kind of scary looking, right? And now let's look at some headlines, some conflicting headlines. All right. This is the kind of thing that investors are dealing with on a daily basis. 3 reasons why JP Morgan's Kolanovic believes the market downside is limited from here. Now, Kolanovic is one of the top people to follow on Wall Street. When we were coming out of the pandemic, when we got into the pandemic, he said right away at the bottom, market's going to fly. It's going to take off. Just a really good calls. But then we get Scott Minerd, who says the Fed raising rates will end in tears for stock investors, says Guggenheim's Scott Minerd, who's another great person, an accurate person to follow. And you get these conflicting headlines all the time. This is going to be great. This is going to be terrible. But we're talking about the same thing. So what do you do? This is where personal finance comes in. This is why we say, okay, money that you need for financial obligations over the next year or 2 should not be in the market. It should be in cash, so it's there when you need it. The rest could be invested. If you have a planned expense in 3 or 4 years, What should it be in? Could be in cash or other type of stable type investments, cash equivalents, CD, savings, money markets. This way, when we have a tough market, we get through the tough market, the market resumes its winning ways, and you didn't have to sell those stocks you have into a down market because you'd have to sell more shares to raise the same amount of money for your financial obligation. So this is why having an all-in or all-out investing strategy to me doesn't work. This is why I don't like to give specific stock market advice on the live stream because you're all different. Okay. So these are the kind of conflicting headlines that we have to deal with all the time, and it creates a lot of confusion for people. And this is why I take you away from the headlines, pull you in like this, like I grab you, grab you by the collar, pull you in like that. I pull you in. They say, listen, buddy, forget the headlines. Let's talk about you and what's best for you and what you're trying to do and your goals over the next 6, 12 months, 2 years, 3 years, 5 years. And we're going to talk about these things and we will map out a strategy that works for you, regardless of whether the market goes up or down in the short term because of a bear market or recession, what have you. That's what we're going to do. And I gently put you back, like smooth out your shirt, fix your collar, and then I do that, and then we're good, man. We're all good, and then we hug it out. We hug it out, and then we're buddies, and then we go to work. That's my strategy, right? That's how I do my thing. All right. Yeah. So if you visit me, make sure you don't wear a shirt that you really like because I might rip it when I pull you in. Okay. Now let's take a look at what's really two things that are really bugging the market. And this is where things get a little bit treacherous. So we're almost done, guys. It's only like 2 minutes left. FedEx. Okay. FedEx is down over $5.50, down another 3.38% today. This is after the stock got clobbered about 25% in one day last Thursday and into Friday. Remember Thursday last week after the close, FedEx came out and said, major slowdown. They have so much uncertainty. There's so much uncertainty in their business and the global economy. And they see everything moving, container ships, airplanes, trucks, everything moves. Major transportation company. And they withdrew their guidance. They withdrew guidance in terms of what their earnings and revenues could be because they see a massive slowdown in the economy and they can't make heads or tails of it. That's a scary thing. And it's news like that comes out after the market that just whacks you over the head. It's scary to buy stocks when at any given time some company like FedEx can come out and say something with really bad news and knock everything down, and then you're kicking yourself for making a purchase that day. All right, and then there's Ford, who had one of the worst days ever. Ford was down over 12% today because they said that they're going to have to spend about $1 billion more than they thought on parts. They can't get parts. There's like 40,000 or 50,000 vehicles that they can't even deliver because they don't have enough parts, especially the higher end products that they sell, which is where the margins are. So Ford, after the market closed yesterday, after market trading, Ford comes out and announces that, and the stock gets clobbered. But when you see stocks like FedEx and Ford that are, very very sensitive to the economy, when these, let's call them, when these canaries in the coal mine warn you about the economy, you really need to pay attention. And it scares the what's out of investors. Investors sell, and it's hard to be optimistic with these companies. So having said that, let's look at one more thing and then we're going to go. Okay. Because investors are so overwhelmingly negative now. Investor confidence is very, very low. So if we get any kind of news out that's not absolutely terrible in terms of inflation or a comment from the Fed and whatnot, we're very subject to upward spikes in the stock market. Any piece of good news could send the stock market way up in a single day. It doesn't mean we're out of the woods. It doesn't mean Well, we're never out of the woods. There's always something to worry about. But it doesn't mean that the issues we're facing go away. That's just generally trading, short covering out rallies, technical reasons for the market to go up and down over the very short term on a day to day basis. But we are subject to some rips in the market. And those rips have consistently been met with selling. We've been in a downtrend this whole year. So, a downtrend is a downtrend until it's not a downtrend. Just like an uptrend is an uptrend until it's not an uptrend. We're in a downtrend. So rips are meant to be sold. That means when the stock market goes up a lot in one day, that's a rip. And then investors sell into it to take advantage of better prices to raise some cash. And I expect that is what we're going to see as the norm for a while. Anyway, by the time we are back together tomorrow, we will see what the Federal Reserve has not only done in its FOMC meeting tomorrow, the Federal Open Markets Committee meeting. That's the group of Federal Reserve bankers that meets every 6 weeks to determine if they should raise short-term interest rates or not, or lower them. And, after it's about 2:15 tomorrow. And then we've got a little time to deal with that. And we'll talk about what the Fed said and how it can affect you. That's about it. Thank you so much for watching. I hope you enjoyed the show. Don't forget to give us a thumbs up. And I'll speak to you tomorrow. If you have any questions, hit me up in the comments. I love hearing from you. Thanks. Bye.